Hi, I'm Dylan. I'm 30. I'm an editor, actor, writer and photographer.
I'm Agnes. I'm a senior consultant in regulatory and risk.
My name is Nicole. I'm 24. I'm currently an actress, model and a business owner.
Hi, I'm Mike, one of the financial coaches at Claro. Today we'll be asking some millennials their opinions on investing. I'll be reacting to their views.
How much money do you need to start investing?
I feel like it depends on what you're investing in, obviously. But generally, to make a profit, from what I've heard, you have to. The more you invest, the more you got to get out of it.
You don't need a specific amount. You don't need hundreds of pounds. You can actually start off with £1. So you can open a life ISA with £1. You can open a cash stocks and share ISA or a cash ISA with £1.
I am a business owner at the moment, but I've only just sort of started, and I guess that I am sort of investing in my own business. But I know that you do need some sort of something to put forward. But yeah, I think it definitely depends on what it is that you're investing in.
Yeah, so they're right. So if we're looking at stocks and shares investment, equities, gone are the days where there's minimum investment levels of £500, £1,000. There are still platforms which have those minimums, but there are many, many platforms today where you can invest from as little as £10.
How much of your disposable income should you be investing?
I do believe that everyone should, take a step back and look at their finances. You need to pay your liabilities, your debt first. Whatever's left that is not allocated to a specific pot, that's what your disposable income is.
I say 10% and I'm not investing 10%, but I feel like that's a good ballpark that you should.
I'd say like half, quarter maybe. It really just depends on how interested you are in investing. But again, as I said before, like the more you put into it, the more you get out of it.
Yeah, so we're not far wrong at all there. It really depends. Anytime you ask a should you question, how much should you be investing, it is very, very subjective and it's intrapersonal to each individual. But if we gauge some general guidance, there is a principle known as the 50-30-20 rule, where basically it would suggest that if you can kind of save, invest, whatever it be, put money aside around 20% of your income, then you're doing pretty well. But whether that's 10%, 15%, 20%, it's up to you, but as a ballpark figure, anywhere from about 10 to 20% would be a great place to start.
When is the best time to invest?
I want to say sooner rather than later, because I think the longer that you leave it, obviously, the longer it's going to take to build up an income from the investment. But I also saying that I think that there's no set age.
When the market's down and you feel like it's going to go up, that's when you want to buy. When it's high and going to go down, that's where you want to sell. And that's how you make a profit in regards to that. But that's just from a very simple understanding of it.
I think the best time to invest is when you're comfortable to put away that money and not think about it. I think people need to remember that investing is for the long haul. So you're putting away a certain amount of money. Don't look at it, just let it do what it needs to do.
To oversimplify it, more often than not, the best time to start is now. The reason being is that the two most powerful factors when we're looking at investment growth over the long term are the amount of money that you put into it and the time that it has to grow and compound. And so if we're looking at both of those factors, the earlier that you can start, generally the better. Now there are a couple of ways that you can obviously do this. We look at lump sum investing versus regular drip feeding. Now with the latter, it's generally the more common approach because people tend to have investment contributions that they put on a monthly basis, for instance, whether that be weekly or monthly. If you drip feed your investments over a period of time, then naturally you'll be buying when investment prices are low, when they're high, and when they're somewhere in the middle. So as a result, over a period of say 5, 10, 15, 20 years, you will be getting an average price of the market. That's what we call dollar cost or pound cost averaging.
How do you safely invest and what are the risks?
I think it's the safest way is obviously to trust the source. So make sure you're going for something that you either A, believe in, or B, that they're legitimate, because there are obviously, as many cool legitimate things as there are to invest in, there are a lot of scams that will be like, oh yeah, invest in this, and it's kind of not really worth your time.
With any investment, there's always risk. I think that's probably what's put me off investing bigger amounts of money, just because you hear of horror stories of people investing all their money or putting their house on the line or whatever it is, and then ended up bankrupt.
The more you look into investing, the more you're aware of the risk. I think the first risk you need to know is what your risk appetite is. Are you someone that is quite a low risk appetite, i.e. you don't really like to take quite big risk with your money? You put it somewhere more safer.
Yeah, so great. So a really good way for particularly new investors to get started is to start small and dip your toes in the water. When people have this conversation of risk when it comes to investing, their biggest fear generally is losing their money. And there are ways and kind of ways that we can go about mitigating that, which could be an hour-long conversation in itself. One of the main ones, though, is diversification. There are many, many ways that we can diversify. It's basically a way of saying don't put all your eggs in one basket. So the number of shares, for instance, that you can invest in, the asset classes that you invest in, whether that be shares, bonds, commodities, property, whatever it is, the region that you're invested in, whether that be the American stock market, the European stock market, Asia, Africa, also what we would call the market cap. So basically big, medium or small companies. There are a bunch of different things that we can do to spread that risk, diversify and basically reduce any unnecessary risk. There are even a lot of platforms nowadays which will do that all for you. All you've got to do is answer a few questions about your situation and your appetite for risk. What would you do in certain scenarios? And they will basically feed back to you what they believe your risk appetite is, and they will make sure that you only invest in investments or funds that are basically suitable for that level of risk. So you can take control of this risk if you want to. And as well as that, to be safe, it's always a good idea to make sure that whatever platform you are using is recognized by the FCA and is covered by the Financial Services Compensation Scheme, or the FSCS.
What is the best investment you can make in your 20s?
I think the best investment you can make in your 20s is to manage your money well.
Well, there's either in yourself or there's in something that, it's going to sound really cheesy, something that you believe in, because at the end of the day, like with a lot of stuff, it's not a guarantee.
I want to say a house. In my opinion, I think getting on the property ladder early is what I've been told is better to do.
Yeah, so again, great answer. So property is a really, really common investment, particularly in the UK. We're all obsessed with property. And if you can get on the property ladder at an earlier age, it's going to make it all the more easy to not have to pay any mortgage payments or rental income when you retire, which is a massive, massive help for retirement income as an example. Now, this is going to sound a little bit cliche, but particularly when you are young in your 20s, one of the best investments that you can make is in yourself. And what do I mean by that? I mean, like we kind of were saying earlier, one of the major things to be able to get the most out of your investment returns is the amount that you put into your investments. So if you can increase your disposable income by investing in yourself, upskilling and getting a higher salary as a result, that's going to have a far, far greater impact than some of the specific investment choices you can make in terms of fund selection. So investing in yourself, especially when you're young, can be really, really powerful to then allow you to invest more from your disposable income. If we're looking, for instance, at a stocks and shares option, stocks and shares choice, then a globally diversified index fund, for instance, which means you can just invest in the global stock market essentially while you're young, again, will allow you to have time for those investment returns to grow. The exponential returns that you'll get from the compounding effect of starting young can be massively, massively powerful.
Would you consider investing?
I have definitely considered it. So it's something that I've thought about probably the last 6 months or so, purely because, you know, the living costs in London and just living costs in general are just going up. And I think, you know, I do think to my future and think, if I haven't invested in anything, am I even going to be able to, you know, afford life? I think investment is a good way to go. And I think just recently as well, a lot of my friends have been talking about crypto, NFTs, Bitcoin, and a lot of them are starting to think about investing into it.
Yes, I'm investing in a few things already, actually. Considering as well, and there's some things that I'm like, yeah, no, I'm not going to do that. It just depends on what it is, essentially. Like, so some things I'm like, okay, I really believe in this project, or I feel like this will benefit me or people I care about.
For me, I would invest in something quite risky. I would do my due diligence. I would look into the company's history, what their performance is like over the past couple of years. And let's be very honest, past performance is not an indicator of future performance. It's not, but it just shows you, the history of the company. And also, one thing people don't look at is company's business plan. So some companies are quite, open in terms of, oh, for the next year, this is what we're going to be doing. And if you monitor the stock market, you're pretty much aware of where the shift is.
So yeah, while crypto can get a bit of a bad rep, it can make a good small addition to a properly well diversified portfolio. Now, if we look at investments in general, we've got to think, what's the alternative? And the alternative for most people, they will immediately look at cash savings. Now, while cash savings are generally seen as very, very safe, they do have one guaranteed risk called inflationary risk, which basically means that if the interest rate you get on your cash savings is not at least keeping up with the rate of inflation, then you are losing money in practical value year on year on year. So bear that in mind when you are looking at cash savings. It's massively important for things like an emergency fund, for example, and absolutely has its place. But when generating a return beyond that, it's really, really important to take that into account. Thanks for watching. That has been Millennial Views on investing. It's been really interesting to hear what people think about investing generally. If you've got any views yourself, thoughts or questions about investing, then pop a comment in the box below. We'll get back to you and we'll see you again soon.